All right, welcome to Unit 3 in our Basics of Business course, where we will be focusing on the numbers and finance side of our service business. Of course, that means we are going to be talking about money. So in order to get started, we're going to focus on the banking side of things first. So our learning targets for today are to talk about the three main functions of a bank and to compare and contrast the two types of banks that are found in our economy. So, when we refer to banks, on the financial side of things, we technically refer to those as a financial institution. And really defined, all that means is that it is a firm that manages money. Banks are one of the main types of financial institutions. There are several others too, but we're going to focus on just one other one. Banks offer a variety of financial services, which simply means that they can hold on to your money in different savings accounts, in checking accounts. They might loan you money for a house, for a car, for a boat, and then they transfer money back and forth between different banks, different accounts, different businesses, etc. And so their main objective, of course, is to help other businesses and consumers manage their money in an appropriate way. So I kind of already alluded to them, but the three main functions of a bank are the first one is to store money. So as we were just mentioning on the previous slide, one of the main services that banks provide is the opportunity to store money for their customers. And when I say store, what I mean is have a place where they can leave it in order to preserve it for later use. So one of the ways that we do that is with a bank account. Of course, this is a place where the bank keeps a record of the amount of money a customer has deposited or withdrawn from a bank. Now, those are two key words that you're going to want to know, not just for basics of business, but just for life in general. Deposit means that you're putting money into your bank account. Withdrawal means that you are taking money out of your bank account. And the main reason that people want to keep their money in a bank is it prevents you from losing it, spending it, or having it stolen easily. If you think about just carrying cash around, cash is a very easy thing to lose. I haven't ever been so lucky as to just find $20 laying on the ground, but um, it's a very easy thing to pull out of your pocket and drop. So losing it is, of course, an option. Some people also feel like when they have cash, it's easier to spend. Of course, that's a personal choice. But some people find cash more readily available and easier to spend than if they have their card. And then, of course, cash is very easy to steal. There is no way to trace cash, and so having it stolen is a, a possibility. Um, so bank accounts typically offer two main types of uh, or banks, excuse me, offer two main types of accounts. The first one is a checking account. This is where you would store your money for a short term. Typically, people don't leave money in their checking accounts for long term because they're paying bills, they're buying things, etc. Some banks charge a fee for checking accounts. It's becoming more common actually to not charge fees for checking accounts. It just depends on your bank, so you really want to make sure you shop around before you decide to go with a certain bank. And then, of course, savings accounts are the other one. Savings accounts are used to store money for a longer period of time. So when you hang on to, or when a bank hangs on to your money for a longer period of time, typically they're going to pay you some sort of interest. And interest, of course, is defined as a rate that the bank pays customers for keeping their money. So essentially, what happens is you give $100 to the bank and you leave it there for a year. You're going to earn a percentage. Let's say it's 2%, you're going to earn $2 on that $100. So now instead of $100, you have $102. So interest is essentially money that you earn because the bank is using your money. The second function of a bank is to transfer money. Transfer simply means to move money. So banks use checks and electronic funds transfers to move money. Checks are one of the primary ways that um, businesses transfer money from one to another. And then our electronic funds transfers, or the EFTs is what they're called. This is simply transferring money online. So one really common EFT is something called a direct deposit. So in our next unit 4, when we talk about um, um, getting employees, you might want to think about whether or not you're going to pay them by direct deposit or if you're going to hand them an actual check. Direct deposit is nice because you don't have to worry about checks. It goes directly into your employee's bank account and it's readily available for them. And then the third function of a bank is lending money. And the thing that we have to think about is that a bank is a business. And so, as a business, they are trying to make money. And so, the money you deposit in a bank makes it possible for the bank to then lend money to other customers. So, I don't know if you ever actually paid attention to that or knew that, but the money that you have in your savings account is actually money that the bank is loaning out. And now I know that's hard to wrap your head around because the banks have to have something called a reserve. They have to have so much money on hand in case a whole bunch of people came in and decided to withdraw their money at one time. And the likelihood of that happening is slim. It's what happened in the Great Depression, but that's we're segueing right now. So back to it. Banks pay customers interest on their savings, and then customers pay interest on the money they borrow from the banks. And so what we have to think about is that the money that the bank pays us for keeping our money there is less than what they charge us when we borrow money. So if you have a savings account at a bank, I'm going to guess that your savings account rate is less than 1% right now. So you're not making very much money. But if you went to that same bank and got a mortgage or a loan for a house, they're going to charge you, I think it's like 3.5% right now. So they're charging you more than they're paying you because they're a business. They need to make money. And then the other thing we have to think about is that most bank loans, if you take a loan, are going to require some sort of collateral. And collateral just means that there's property or goods that are pledged to the borrower as security against a loan. And all that means is that if you have a loan on a house, your house serves as collateral. So if you don't pay your mortgage, the bank could seize your house. Same thing with a car. If you have a loan on your car, your car serves as collateral, and so if you don't pay your car loan, you could end up having your car seized by the bank. And so, a couple of things to know about loans. Loans are just any amount of money that's borrowed, and then you're expected to obviously repay with interest. It's not like getting a loan from your mom and dad, where if they give you $20, you pay back $20 and you're good. If you take a loan from a bank, you're going to have to pay additional fees and interest in order to borrow that money. So you receive a loan, let's say when we ask for a loan to start our businesses, let's say we're going to ask for $50,000. You do not have to pay back that $50,000 in one chunk. Instead, typically what you're going to do is you're going to repay it monthly. So your bank is going to charge you interest and fees in order to offer that service. So the total cost of your loan is going to depend on how much you borrow, what your interest rate is, and the term of your loan. So your principal, remember, is your $50,000. Your interest rate, or your APR, is what the lender charges for the use of your money. Let's say your interest rate is 5%. Okay, so there you're going to charge you 5% per year on whatever amount you have outstanding. And then the term is how long you're going to repay your loan. The shorter your term, the less interest you're going to pay. But the longer your term, the more interest you're going to pay. And obviously, we want to keep our interest rate as low as possible because that's going to lower the total cost of your loan. So this just kind of describes what we were talking about. The bank is lending money. These people, customers of the bank, put money into the bank, and then the bank pays them back interest as a return on their savings. And these people, the bank is borrowing money to these customers, and then they're paying the interest back to them. And remember, this amount is going to be more than what they're paying you. That's how the bank makes their money. Now, the other type of financial institution I want to talk about real quick is that banks can actually operate on a state, a national, and international levels. We have very strict rules for starting a bank because obviously they're going to handle large amounts of money, so they want to make sure that they are not, um, that something isn't going to happen to them, which is what we call FDIC insured. So to open a federal or a state bank in the US, you have to meet specific requirements. You have to apply for a charter, similar to the way that we've talked about filing for a corporation. And obviously, you have to have enough capital to start a bank. Capital meaning money. And so in the US, there's actually two types of banks. There's commercial banks and then there's credit unions. Commercial banks are what we typically think of when we think of most banks in the US. They offer an entire range of banking services from checking and savings accounts to loans. They might also do some investing as well. A lot of times, commercial banks are called full service banks, and they also serve both individuals and businesses. So remember that as a business, as a service business, you have to bank with a bank. Just like you would have your own personal checking account, your business is also going to have a checking and savings account. And so you have to apply for a charter or a license, and it's granted by the federal or state government. Some examples of commercial banks are like Wells Fargo, Gate City Bank, Bell Bank, US Bank. Those are all commercial banks. And remember, they are for profit businesses, meaning that they charge more interest on the money that they lend than the interest that they pay on their savings account, and that's how they make money. The other type of financial institution is a credit union, and a credit union is a not for profit bank that's set up by an organization for their customers to use. So with a credit union, they actually call their customers members. And so with a credit union, you have to have a specific, um, you have to meet certain regulations. So, for example, we have a credit union for Fargo Public Schools, and you have to be a member or an employee of Fargo Public Schools in order to bank at that credit union. Credit unions are still going to offer the majority of the same services that a full service bank does. It's just that they may have not as many services. They may not have like investing financial investing in the credit union and the size of it where they're at. Some credit unions pay interest on their checking accounts, but not all. Of course, some full service banks also do that too. I thought I had more on there. One reason where people might choose to go with a credit union instead of a full service bank is that credit unions are typically smaller. You may have more of a they may know you more than so like Wells Fargo where you might just be a number to them. So some people like that personal interaction. And typically they have better interest rates on loans and better interest rates on your savings accounts just because they're smaller and have the ability to do that. So when we get into talking about this for our business plans, we're going to decide whether or not we want to bank at a full service bank, a commercial bank, or if we want to go with a credit union. So that's just something to keep in mind as we move forward. Um, and so we will want to think about that when we get ready to do our business plan.